In today's video, we are going to talk about why Tesla is not a bubble and why it's also one of the best short-term trading stocks around. If those topics interest you, please stick around. Hi, I'm Steven Spencer. I'm a partner at S&B Capital. We're a prop trading firm in New York City where we trade stocks, futures, and options. So the topic du jour is Tesla. People love to trade Tesla. People love to talk about Tesla. There's three things that you need to know. Number one, Tesla is not a bubble. Number two, Tesla is not going to drop 80%. And finally, Tesla will be a multi-trillion-dollar company in a few years. So S&B is a short-term trading desk. Our focus is understanding how fundamental news can act as a catalyst for short-term stock movements. There's a huge edge to be gained in the marketplace if you can figure out what the largest market participants view as important to a particular company. We spend a lot of time teaching trainees on our desk this process. We have a free 2-hour workshop where we teach part of this process, as well as 3 low-risk intraday trading strategies at tradingworkshop.com. One of the difficulties I had at the start of my career was my background. I studied at a top undergraduate business program. I was a tech geek since I was a small kid. I actually was a member of a model rocket club for a few years. I read the New York Times science section, and when I began my trading career at a short-term momentum trading desk, I had some problems in my first year. I allowed my fundamental knowledge to impact my trading decisions. This caused unnecessary losses. Fundamental news will impact short-term price movement, but sometimes those short-term movements aren't particularly rational. You may believe a piece of news should cause a stock to go up 5%, but it'll go up 15, 20% or more. You may see a fundamental piece of news that should cause the stock to drop 5%, but it will drop 10, 20% or more. If you have a strong view that a stock should only move X% because of a certain piece of news, and you don't have a well-developed trading plan, you'll be run over by the market. You'll blow up your trading account and your career will be over before it even starts. This leads me to the video that S&B partner Mike Bellafiore did recently with Trey, one of the traders on our desk, who has a very strong fundamental view of Tesla. Let me get this out of the way quickly by saying there was virtually nothing he said about Tesla's fundamentals that I agreed with. Interestingly enough, what he called a core tenet of his thesis was the idea that Tesla was similar to other automotive manufacturers and therefore their margins in the future would be similar to those companies. While his belief is incorrect, and I'll explain that to you in a moment, his focus on automotive gross margins is very important with respect to short-term trading. And furthermore, during their discussion, although I disagreed with what he was saying about the fundamentals of Tesla, when they started to talk about market structure and the actual trading of his short trade, that portion was very good. He has a good grasp of market structure. Mike gave him some pushback on some of the fundamental ideas, and Mike really helped him focus in on what is the price action telling us, what is the market structure telling us, and that led to a very successful trade. And later on in the video, I will address my thought process at the same time, how I attacked that short setup as it unfolded. Back to the topic of gross margins in the automotive industry. Gross margins range between 13 and 20%. In a group of car makers in the survey that correlate closely with their brand positioning. Premium brands enjoy a higher gross margin than mainstream and budget brands, with some notable exceptions. If we look at BMW, it's a premium brand. For a number of years, in most recent years, their gross margins were above 20%. In 2018, Tesla began to ramp Model 3 production, and when this happened, you could see margins at BMW started to go down pretty swiftly. And that's because the Model 3 was taking share from BMW and other premium automakers. And in fact, they were actually pulling people from lower priced cars like the Toyota Camry and the Honda Accord. And so Tesla was showing that they had pricing power, that they could do, when they ramped production, they could be above 20%. And I believe over time what we'll see is those margins will move up to 25% and eventually will be over 30%. And I can kind of walk you through why I believe that's to be the case. But I want to be really clear about this. Trey had said his core thesis was Tesla can never grow margins. The margins eventually in the long term will be weak, and the stock price can't be justified. I think there's already enough data out there. If we actually look at a chart in recent years of Tesla's gross margins, they've pretty consistently been able to get above 20%, and in 2020 even start to move towards the mid 20% range. And so when I look at people who have been reliably good in their predictions in terms of Tesla's earnings and their margins in the last few years, I'm seeing potential margins in the 25 to 30% range this year. And so we'll have some more data as that rolls out. So I'm not trying to even make the case that Tesla's stock price at, let's call it between $700 and $800 a share, needs to be justified by a future robo-taxi network, that needs to be justified by the energy business, which I believe at the end of this decade will be a $100 billion plus revenue business. All I'm going to talk about today is their automotive gross margins, what that looks like over the next few years, and kind of their ramp in production, and what that looks like for their earnings per share. And you can justify a price right now, I believe, between $700 and $800 a share. And by the end of this year, certainly north of $900 or even $1,000 a share. The way that Tesla is going to grow their margins from the low 20s where they are now to north of 30% is in three ways: battery innovation, factory innovation, and software revenue. Legacy automakers cannot compete with Tesla on any of these fronts. The core reason is legacy automakers are optimized to make internal combustion engines, and that is not what an EV is about. They outsource the vast majority of their parts to part suppliers, so they're not vertically integrated like Tesla, and so they just can't compete in the EV space. Although electric cars share some of the same parts as an internal combustion engine car, the most expensive and important parts are not areas where legacy automakers have any expertise at all. These are batteries, electric motors and drivetrains, and software. And Tesla has huge advantages in these areas, and that's where they're going to make huge profit margins. So they've spent over a decade building teams in each of these areas and literally have 5 to 10 years of a lead in each area. We'll take a look at some of the price structure for the legacy automakers. You'll see where Tesla already has a huge advantage, and Tesla's costs of manufacturing are coming down. We'll spend a little bit of time talking about that as well, and understanding that Tesla has built these talented teams in the last decade, and now if you go to engineers and you survey them, Tesla is the number one, and SpaceX is the number 2 ranked place to work for engineering students. So they have the talent, Tesla, and they're going to get the future talent. And legacy automakers who are years behind have no way to really catch up. Okay, so let's take a look at, spend a few minutes just talking about how Tesla grows their margins from the low 20s into the 30s over the next few years, or maybe sooner. The reason we want to address this is the core thesis in the video that Mike Bellafiore did with Trey is he believed that the automotive gross margins could not grow, and perhaps maybe would go down as competition would come around from legacy automakers. And so this is a very different product. An EV is not an internal combustion engine car. The major cost centers and the major value added is in completely different areas. So growing high margins. Number one, battery innovation. So as I said earlier, they've been doing this research for 15 years. They already have a 20 to 40% lower cost structure than competitors. And we'll look at a few charts there and understand that about 6 months ago, Tesla had what was termed Battery Day, where they outlined a path over the next few years to reduce their cost per kilowatt for batteries, that's how battery costs are measured, by another 56%. Now understand, they already have this lead, this 20 to 40% lead over other producers in terms of batteries, and that really is a large part of why they have over 20% margins already, whereas legacy automakers are at best case break even or losing money on some of their sales, depending on the particular manufacturer. Number two, factory innovation. Tesla's first factory was in California. They bought it from legacy automakers. They got it on the cheap, and it was just not designed to be efficient in terms of production for EVs. And when they built their second factory in 2019, and they built that in record time, they built it in 12 months and the first cars started rolling off their assembly line within 12 months. What they saw was a 40% improvement in their CapEx spending per unit of capacity. Every car that rolls off an assembly line, it's not just the raw materials that are going into it, it's the labor hours, the man hours, as well as the number of machines and equipment and the speed with which these cars come off the assembly line, and that's accounted for with the cost of a particular factory. And we were seeing those costs come way down, and that's why once the Shanghai factory ramped to full production of their initial lines for the Model 3, we started to see huge profit growth in the third quarter of 2019 and the fourth quarter of 2019 as well, and continued profitability in 2020 despite the global pandemic that hit earnings in the first and second quarters. And then finally, is they actually have brought in billions of dollars of revenue on the software side. And when you crunch the numbers, over the last couple of years, it comes in the area from about 2,000 to 3,000, depending on the quarter, per car sold. And the way you do that is you look at the price of their full self-driving software, what the take is, what percentage of people who are buying cars are buying that software, and then bring out that revenue over the cost of the entire sales for the quarter. What we'll see is when we look at some of these analyst reports a little bit in some of their slides, they have 85% margins on software. And so as more people buy the full self-driving software, as it gets better and better, as that moves up to 30%, 40%, and I think eventually probably gets to 50% in the next couple of years, because it is really a true pleasure. I have a Model 3, I have the autopilot software, and actually the full self-driving, which hasn't fully rolled out yet. I don't have the full self-driving version. I think it's rolling out to the fleet over the next month or so. But just the basic things that I have now, where it steers on the highway, it changes lanes for me. It makes the driving experience completely different, and that's why we've seen 25 to 30% of people in the U.S. buy that option. It's a little bit more complicated globally because there's more restrictions in Europe. In China, the software hasn't fully gotten up to speed, but eventually we're going to see high take rates in Europe and China as well, once the regulatory issues and the software is comparable to what we're seeing on U.S. roads. So when you put those three things together, cost of battery coming down, cost of each factory that they're building coming down. They're doing 2 more factories this year as well, Giga Berlin and Giga Austin. And then the software getting a higher take rate, and then they're also increasing the price of it as well. When you combine those things, it's very easy to see a path to 25 to 30% for gross margins in the near term, like this year and next, and then eventually in the 2023 to 2025, 30% or more. There was someone by name of Wright about 100 years ago came up with a theory, and the data has borne itself out in the automotive industry. And what that predicts is manufacturing costs of a product will drop by a fixed percentage after the cumulative doubling of production. So what we've seen in the automotive sector, vehicle costs after each doubling of cumulative production have dropped 15%. And so if we look at a chart of the Model T when it started, it cost thousands of dollars per unit. And then when the cumulative production would double, it would drop 15%. And that held pretty much true over the first 15 years of production. And what this means for those who might be confused by this, let's say you produce 1,000 cars. Those first 1,000 cars might cost you $100,000 to produce. You sell them at $50,000 at a loss, but you understand as you scale production, your costs will come down. This law maybe kicks in at 100,000 units. At 100,000 units of cumulative production, you're now down at the 50,000 cost per vehicle, and you're at break even, and then you get to 200,000, 400,000 maybe after another couple of years, and then eventually 1 million, and you're getting a 15% drop in costs, a 15% drop in costs, 15% drop in costs. And what you're able to do is not only make more profits and increase your margins, you can pass along some of that savings to your customers. Here you go, Wright's law applied to the Model 3. If you look at that, it came out in 2017, was extremely expensive to produce their first unit, and then it basically got on this cost curve, and you can see held it really well, coming up into the first 800,000 units or 1 million units of a production. And what we're seeing now is as they have 3 factories and they're ramping, I think this year maybe they'll produce about 500,000 Model 3s. They'll get to over that 1 million mark. And then I think by the end of maybe 2023, they'll get to the 2 million mark. Their costs will drop another 15%. And ultimately, by the end of 2025, ARC thinks they'll have produced 10 million Model 3s, and the costs are going to come way down. And it's going to be somewhere in the probably 20 to 25,000 range. So you could see by the end of 25, Tesla brings the Model 3 standard range down to 25,000, and then everything else, the software is an add-on. Maybe the software will cost 15 or 20,000 at that point, or $500 a month or something like that. Their long-term goal, Tesla, is to really make most of their money on software and services. And so, if they maintain a 20% margin to 20% margin on just the actual physical product that they're selling, the automobile, and they pull in most of their money on the software side, that's going to serve them really well in terms of evaluation. One final chart just on where we are in terms of the price of batteries coming down. And by the way, a battery might have cost Tesla a few years ago $20,000 for a battery. Now it's under 10. Eventually it's going to be 4,000 or 5,000. Goes to margin. They save 1,000 on the battery, 500 to margin, 500 in lowered costs. They can pick and choose how they want to pass this along. They can pretty much dictate where their margins are going. And that's because when you look at this chart, there's this big gap between where their costs are right now and their competitors. And they're on this downward trajectory, much steeper downward pricing cost trajectory than their competition. So we just spent some time going through the three areas of innovation where Tesla's going to scale their gross margins, their automotive gross margins from 20 into the 30s. And now I want to talk a little bit about price action when we have a high margin growth company, technology company, how the market views that. So Tesla is a growth company. This attracts a very specific type of hedge funds and investors. As long as they grow and beat Wall Street's expectations, people will pay higher prices over time. During short periods of time, the stock will move up too quickly, which normally will lead to sharp corrections and sideways movement, which we know as consolidation. And then in the following quarters, as long as the numbers are good and analysts raise their estimates, eventually the stock will attract buyers at even higher prices. So if we take a look at the Netflix chart, on the left side of the chart between, 2005 and 10, you can see had a lot of resistance. The market started to recognize that their business was shifting towards streaming away from DVDs. It had this explosive move. And then for the first time in Netflix's history, the management made a misstep, which was they upset their customers by saying they were going to split the streaming business from the DVD business. The DVD business was going to go away. I think at that point 80 or 90% of their customers were DVD customers, and the stock tanked. That was probably the best buying opportunity, other than Tesla a couple of years ago, the best buying opportunity of a growth momentum stock in the last decade. When it got below 50, it was actually, I guess, what is that, about $7 split adjusted. That's when it caught my attention and I was interested in getting long. And it took a while for it to take out that high. The next year and a half, it took out that high. But once it did, you can see it started to move sideways and then trended higher, move sideways. Then would trend higher, move sideways. Because it's a weekly chart, log chart, it doesn't look like those moves are too big once it took out the high in 2014 or so. But basically, it went up a couple 100%, and then it would pull back 30 or 40%. And it would do that over the course of a year. It would consolidate and then move up a couple of 100%, move sideways, pull back 30, 35%. And now you can see we're at a very tight consolidation. It's in a very strong weekly uptrend. And understand, Netflix's growth rate has decelerated, but its cash flows have become more certain. And so by comparing to Netflix, I'm not trying to say they're in similar businesses. What I'm saying is momentum hedge funds, momentum investors, growth investors, they look at these things similarly in terms of they're looking at things that are going to have compounded annual growth rates of above 30%. So let's compare the Tesla weekly chart to the Netflix weekly chart. So if we go all the way to the left-hand side, you can see when the Model S got introduced back in 2013, Tesla went up a few 100%. And then it just moved sideways for about 5 years. And during that time, they were improving their processes, coming up with a plan on how to ramp mass market cars, the Model 3s and the Model Ys. And their revenues kept on growing and growing, and it would go to the top of the range, and then it would pull back to the bottom of the range, and would go to the top of the range, pull back to the bottom of the range. And what happened was, in 2019, they had one bad quarter. One bad quarter, the market, people got very nervous, and it was the Q1, which is always historically, they're always their weak quarter for car sales. But then over the next couple of quarters, the numbers started to get better, and then they just got explosively better by the third quarter. And you see the breakout after Q4's earnings, where it went up a couple 100%. and at that time I think it was about 200% or so, and it pulled back. I don't believe it would have retested the breakout, but for the fact that we had a global pandemic and the stock market dropped. I don't remember how much the SPY dropped. It probably was 30% or something like that. And so that helped it pull back, and it took out the highs and was really the strongest stock in the market overall in 2020. And so a natural thing to do at that point, after it has this big move from $75 a share up to 900, it's a 10x from the low to the high. Even from the high, from let's say 180 where it broke out from the prior high before the pandemic sell-off, 180 to the 800s is 400 and something percent move. You would expect some sort of pullback. And so this brings us to kind of the most recent pullback where it had topped out in the high 800s in January and was moving sideways. And I can tell you that for myself, my thought process was, let's see which way this breaks. And I thought that if it broke to the upside, it wasn't going to go much further because it just had already a huge move in 2020. But I thought it could maybe go up 10%, something like that. If it broke out from 880, it could maybe go up to about 950. And I've been thinking that for several months before it even got into that range when it was moving up from the 700 area. And eventually what happened was they reported earnings. The numbers weren't good. And this is another reason why I think it was on my radar and other people's radar for potential pullback. The numbers were not good. They had blowout quarter after blowout quarter from Q3 2019 to Q3 of 2020. Q4 was not a good quarter. It was good from a revenue standpoint, but the margins came down a few hundred basis points from the prior quarter. They had some reasons that they explained in the conference call. And I think that's why when it went under 800 there in the middle of the consolidation and went back up to 880 again, people said, okay, we believe your explanation. We're giving you the benefit of the doubt. The prior 4 quarters were awesome. We think next quarter could be a strong quarter again, even though it's Q1 with seasonally weak, and we're going to go back up. But then they announced they bought Bitcoin, and I used that opportunity to actually buy some puts, because buying Bitcoin is not something that is driving their margins or doing any fundamentally good. And it got up to where it just failed post-earnings high around 880 a share. I said, it's at 870, it's near the post-earnings high. Let me buy some 850 puts, let's see what happens. A couple of days later, it got hammered, went down to 800. I covered most of those puts. And then I started watching it to see if it would support the post-earnings low. It did, it got back above 800 on I believe an upgrade. I forget, maybe it was the Piper Sandler upgrade to 1200 target. And it gapped up to 820 a share and immediately got sold pretty hard. So I bought puts again, 780 puts. So at this point, I'm thinking, price action, it's gone from 400 when the S&P was going to announce the ad to above 800. It's a double. It's a good play. And so that's how I was thinking about it. And I was not thinking, the one thing I will say, I was not thinking it was going to have a 30 to 35% pullback at that point. And the main reason is as the 5th largest component in the S&P now, I just think it would take away some of the volatility. So although in 2020 we saw 3 or 4 30% plus pullbacks, and that's how I was playing it then in terms from an options standpoint, those are the types of pullbacks I was looking for. I was thinking more like 20, 25% stretch. And so a couple of days later, when it sold off pretty hard, when it got down to 620, I was aggressively buying it because at that point it was down between 25 and 30%. So I was aggressively buying, adding longer term position as well as short term, and playing it for a bounce back up to see what it would do, if it bounced back up into the 720 to 750 area. It failed there. It started to form a downtrend. Then we know the rest is history. Momentum stocks got sold, RK got sold, and they all got hammered in a few days. And that's what drove the low print a week and a half ago was the 40% pullback. Got extremely aggressively long there when it got below. I actually tweeted out that day, if you have a 6-month time horizon. I normally don't tweet long-term ideas on Twitter, so if I do it, usually people will pay attention. And that day it bottomed, reversed. You had one more chance to buy it at 650, and since then, 550, it's bounced about $150 or so. As we're filming, it's stock's trading around 700. We just talked about the most recent pullback. This was a product of two things. In my view, it had a very large run-up in 2020. They had a disappointing Q4. The ramp-ups in their products in Shanghai, the Model Y, as well as the US, has not been ramping as quickly as some people maybe expected. And so there was some profit taking. And then you had the momentum sector sold. And once the ball got rolling, it pulled back more. For this stock to pull back more than it's done already, to take out the low, it's going to have to disappoint growth and momentum investors. So let's take a look at the earnings estimates that are coming up, and to how we want to think about this from a bigger picture perspective. So here's Gary Black, former chief investment officer at Goldman Sachs Asset Management, former, I think, president at Janus, very experienced, knows how to do models, earnings models, has been an investor from 2019, the same time that I invested, and was spot on when he sold in the 870s. In January, he explained his reasons why. It then dropped over $200. He bought his position back. So he's long the stock. Here's his analysis. He's at around $4.50 a share for this year. The street is around $4. And his 6 to 12 month price target is $9.60 based on just doing pure discounted cash flow analysis. He's not including robo-taxis. He's not including energy. He's just, these are the cars they sell. These are what their margins. This is what the cash flow is. Here's my gross margins assumptions. He's got it moving to up to 24 next year. He's got it in the low 20s, 23% this year. Over the course of the decade, he's got it moving higher. He's also, let's look at 2022. He's at $9 where the street is under $6, and that's where this comes into play. As you see Tesla report next quarter and the quarter after, and they beat their numbers, and analysts start to raise their earnings estimates, then price targets will go up, and it's a momentum game where people will pay higher prices, it'll trend higher, and then it will consolidate and move sideways. We showed you that in the weekly chart in Netflix. I think kind of that's where we are in Tesla right now, where Netflix was in, let's say, 2016 or 17. We're going to have one of these horizontal consolidations. It's going to move higher. We're going to have another horizontal consolidation, and it'll continue to do this for the next few years as long as they're maintaining this high rate of growth. I also wanted to take a look at Piper Sandler, who has a $1,200 target over the next year. One of the most highly rated analysts on the street based on his performance, his price targets, and the stocks that he covers. If we look at his numbers, you can see for 21 and 22, he is at 476 for this year, and he's at 968 for next year. So that's very aggressive. Remember, the street next year is at 580. He's at 968. So if we end up if 2022 for Tesla comes in between 8 and 10, and those analyst estimates have to move up from 580, they'll move up to 650, then they'll move up to 7. Each time they get revised higher, that adds buyers at higher prices for the stock. And that's why these weekly charts look like they do. The same thing was going on in Netflix years ago, and this is what I believe is going to happen in Tesla over the next 2 to 3 years as analysts start to catch up with what the growth rate really is. And in terms of this year, he's at 476, so he's about 15 to 20% above where the street is. And then finally, just to share one more, this was an upgrade the other day from New Street. They've been really good on the stock. The reason I chose these three analysts is not just because they have price targets above where the stock is. Over the last 2-3 years, when I've been following the stock extremely closely, their analysis has been spot on, whereas traditional Wall Street analysts got it completely wrong, and they had to play catch up in the last 12 months, and they're still way behind, even though they've been playing catch up. So in terms of New Street, another highly rated analyst, not as high as Piper, but certainly 3.5 stars, doing pretty well, decent track record. For 2021, he is at $4.30, so he's not that much above where the street is, only about 7 or 8%. And then for next year, he has explosive growth on the earnings at $7.90. And that's where I've got my range from between his $7.90 and Piper Sandler and Gary Black's numbers. You're between $8 and $10 a share. Let's see, maybe that lands, maybe it only goes to $8 for next year, but that's still more than 30% above where the street is right now. A lot of room for upward revisions. For those of you who are just interested in terms of the trading, understand that this is a growth and momentum stock. It's just like Twilio. It's just like Netflix and Amazon, the names that we've already named. Roku is probably top 5 growth momentum stocks. You got Roku, you have Baidu. What you're looking for in these companies are analysts raising, are they beating by 20%? Then analysts have to raise their numbers. As long as they're beating and analysts have to raise for the next quarter, the next year, the stocks will continue to move to higher prices. And sometimes they'll get 1 quarter benefit of the doubt. It looked like that was going to be in the case in Tesla until they bought Bitcoin and it sold off 25%, and then the momentum names got killed and it sold off another 10%. It got caught up in that. But generally speaking, if you can show a track record, you're a growth stock, 4 good quarters, okay, 1 quarter, it's the growth. The curve's always not going to be this perfectly smooth thing. You're going to have, up and down as you build more factories, as you ramp production, et cetera. But that's the key takeaway. As long as this continues to be the trend, as long as Tesla continues to compound at 50% or above annual growth rate, and they continue to expand their margins, which they've shown they can do over the last year or so, they're going to be, if not the largest market cap company in the world, one of the largest. Tesla pretty quickly is going to move up past Tencent and Facebook, and it wouldn't surprise me if they move past Google in the next couple of years. And I would think by 2025, depending on how much these other companies move up in market cap, you very easily could see Tesla in the top, spot, or top 3 at least. Regardless of whether or not Tesla trades to $2,000 a share or $200 a share, the way that short-term traders make money is understanding how fundamental pieces of information are going to influence large market participants or a lot of market participants in the short run. So it does not matter that a trader on our desk believes that Tesla's margins are going to collapse in the future. What matters is the stock had just run up several 100%. It reported they missed earnings. It failed to make a new high. And then there was some structural information, meaning money kept on flowing into the market, momentum and growth funds. And despite that, the price wasn't moving up. And then there was a price signal where it dropped down hard below $800 a share. And that was a signal to enter onto the short side. And I have the complete opposite belief. Long term, I believe their margins will expand. They'll make tens of billions, if not hundreds of billions of dollars, and the stock will go much higher. But that didn't change my view that after it stalled out in the high 800s, failed to make a new high, and then moved down hard below $800 a share, and then failed the next time it came back up, that it couldn't sell off. And so ultimately, as a short-term trader, your job is to identify what these patterns look like, what the structural issues are in the market that can cause these large moves, and then have a trading plan and trade management accordingly. Hope this helped, and I'll see you next time.